Welcome back to the deep dive. You get these massive corporate earnings presentations, and they're just dense, full of acronyms, billions of dollars, and it's our job to find the real story buried in those spreadsheets. So you sent us the full stack on Goldman Sachs' 2025 results. And our mission today is pretty clear. We're going to cut through that noise and really deliver the story of their strategic pivot, that big cleanup they did, and where their new growth engines are.
And it's an important mission because this presentation, it's not just numbers, it's really a story of execution. I mean, the whole narrative in these sources is about delivering on a strategy they laid out years ago at their first investor day. It's all about maximizing that core institutional business and, reducing their consumer risk.
And when you pull back and look at the big picture, the results are, well, pretty stunning. Let's just start with the one number that really screams success. Since 2019, total shareholder return is up 341%.
That's the payoff right there. That's the ultimate report card. But if we zoom in on 2025 specifically, the firm delivered, $58.28 billion in net revenues. And their return on equity, the ROE, which is that key measure of how well they're using shareholder money, it came in at exactly 15.0%.
So they are in their targets.
They are. It shows they're growing revenues while really improving the returns across the entire firm structurally.
Okay, but to get that kind of clarity, they had to take some medicine in the short term. Which brings us right to that big headline item, the exit from the consumer business, specifically getting rid of the Apple Card program. We all knew it was coming. But how did that massive move actually land on their books for 2025?
Well, it left a very large and very visible mark on the Platform Solutions segment. To exit, they had to take a $2.26 billion reduction in net revenues in that one segment. And that number covers a couple of things. Marking down the credit card portfolio because they're selling it, and then the cost to actually terminate the contract.
Okay, let's unpack this. A $2.26 billion revenue hit. That's a huge line item. To anyone just glancing at this, that looks like a gigantic loss. Is there anything in the accounting that softens that blow on the bottom line?
That's the absolute crucial detail. Because they were getting rid of the loan portfolio, they also got rid of the risk that came with it. You can think of it like this. For every loan, they had already put money aside in case it went bad. That's the provision for credit losses. So once you sell the loan, you sell the risk, and you can release those reserves you set aside.
So they book a loss on the sale itself, but since the risk is gone, they can basically cash in the insurance policy they'd set up for that risk.
Precisely. They booked a massive $2.48 billion benefit from that reserve release.
Wow. So they really use the accounting structure here to minimize the net damage. When you factor everything in, the card transition, the FDIC fee, the total pre-tax impact was actually a net positive of $203 million. So they took the short-term pain for that long-term strategic clarity, and they did it with incredible efficiency. The deck is cleared.
Exactly. And now we can move from the cleanup to where they're really making their money. We have to talk about the engine room, global banking and markets, or GBM. This is their institutional core, right? Investment banking, FICC, equities. And in 2025, this business was just a massive success story. A record $41.453 billion in net revenues.
$41 billion from one segment. That's just a staggering number. What specifically was driving that performance? I saw the sources pointing to a big M&A spike.
It was primarily that bounce back in merger and acquisition activity. Their investment banking fees hit $9.3 billion, up 21%. But the advisory side, the actual M&A consulting, that grew by 34%. It just validates their dominance. I mean, they've been the #1 M&A advisor for 23 years, and they kept that title for 2025.
But M&A is famously cyclical, right?
Yeah.
It depends so much on market confidence in the macro environment. How do they justify that reliance? What gives them confidence that this will continue into 2026?
That's where the backlog comes in. The firm was very specific about this. They said their M&A pipeline, their backlog, is the highest it's been in 4 years. It's over $250 billion.
Okay, so that gives them incredible visibility into future revenues.
It does, and it creates a sort of multiplier effect. M&A deals drive demand for financing and hedging, which leads us right to their next big strength.
Which would be that big growth in financing revenues. It hit, $11.4 billion for 2025? I noticed the sources called out a 17% compound annual growth rate since 2021. That's really impressive stability.
It's crucial because that growth represents stickier, client-driven revenue. It helps protect the business when M&A activity slows down. Specifically, equities financing was a huge driver. Net revenue's up 31%, mostly from prime brokerage and portfolio financing. It just shows they're successfully winning assets from hedge funds and other big clients, creating these stable fees in a segment that used to be all about trading gains.
And let's just quickly clarify for our listeners, when we say FICC, we're talking about fixed income, currencies, and commodities trading, correct?
That's right. The rates desk, credit, foreign exchange. And that side of the business, their intermediation business, was also incredibly strong in 2025. FICC saw much higher revenues in things like interest rate products and commodities, basically areas that had huge volatility during the year.
So if the market got messy, they made money helping clients navigate that mess.
Exactly. And the same story in equities intermediation. Record net revenues there, mostly from derivatives. So whether it was helping companies manage risk or doing complex trades for big clients, they captured that volatility. The message from GBM is just crystal clear. Their institutional franchise is dominant.
So if GBM is the engine delivering all the growth today, then it really seems like asset and wealth management, AWM, is their long-term stabilization play. The focus there is all on that durable, sticky, fee-based revenue.
Absolutely. The whole pivot here is about durability. And the main metric that shows this is their total assets under supervision, or AUS. It reached a record $3.61 trillion in 2025. And that growth was not an accident. It was driven by market appreciation, yes, but critically, by net inflows across every single asset class.
And those inflows translate directly into stable fees. The management fees hit a record $11.5 billion, up 11%. But the consistency is the real story.
Yeah.
I saw this fact in the sources and it just jumped out at me. This was their 32nd consecutive quarter of long-term fee-based net inflows. That is 8 straight years of constant client growth.
It's incredible. It's proof of client conviction. And within AWM, the alternative space is quickly becoming the real powerhouse. It's almost hard to get your head around them raising a record $115 billion for alternatives in 2025 alone. That brings their total since 2019 to $438 billion.
And they're not shy about their ambitions here. They're targeting $75 to $100 billion in annual fundraising. And they want to hit $750 billion in alternatives AUS by 2030. What does reaching a target like that actually mean for the character of Goldman Sachs as a firm?
It fundamentally shifts their risk profile and, by extension, their valuation. The old Goldman Sachs was really exposed to its own balance sheet, investing its own capital in deals. They call it HPI, historical principal investments. Fee-based revenue from managing client money, especially in alternatives, is just so much more stable and predictable. When you do that, Wall Street rewards you with a higher valuation.
And we can see them actively unwinding that old HPI model, can't we? The source is pointing to a huge reduction.
That's right. They've cut HPI by about $57.5 billion since 2019. It's down to just $6 billion now. So you can see them de-risking the balance sheet while they build up the fee machine at the same time. The sources noted that while AWM's ROE was 12.5%, that number was actually dragged down by about 2.3 percentage points because of the HPI wind down and that one-off FDIC fee.
So the underlying fee business is actually performing closer to a 15% ROE once you strip out those strategic costs.
Yeah.
That's a really important piece of context.
Exactly. And they're not just waiting for organic growth. They are strategically buying their way into these areas. The report mentioned partnering with T. Rowe Price for the retirement channel, buying industry ventures for venture capital secondaries, and acquiring innovator ETFs to scale up in active ETFs. They're meticulously filling in the gaps.
All right, let's shift gears a bit to the infrastructure that supports all this growth, the efficiency strategy. They're calling it 1GS 3.0. This is really the foundation that lets them reliably hit those mid-teens returns.
1GS 3.0. It sounds like a massive systems overhaul. We're talking about operational efficiency, and it's all propelled by artificial intelligence. What's the big idea here? How do they make the firm leaner without, cutting into the revenue engine? The philosophy is about optimization. They're using AI to eliminate what the firm calls toil. That's the repetitive, high-friction manual work. The goals are pretty straightforward. Drive productivity, improve profitability, and ultimately make the client experience better, faster, smoother.
Okay, they can sound like buzzwords, but where are we actually seeing the AI being deployed in a way that's going to hit the bottom line? Can you give us a concrete example of how this stuff actually reduces costs?
Sure. Look at compliance and onboarding. They listed a few key areas, but let's just focus on two. Client onboarding, KYC, and regulatory reporting. I mean, these processes are traditionally incredibly labor-intensive. You have huge teams manually verifying documents, checking databases, compiling reports. By deploying AI and automation here, they can handle way more client volume without having to hire more people. That flows directly to lower operating expenses.
So AI isn't just about some fancy trading algorithm. It's about fundamentally changing the back office to lower the cost of doing business. And that automation is what lets them target an efficiency ratio around 60%.
Precisely. Automating those data-heavy tasks like risk management and regulatory reporting is the key to structurally bringing that efficiency ratio down over time. It makes their profit less dependent on revenue swings and more dependent on controlled costs.
And all this, the growth, the efficiency, it all relies on a rock-solid capital base. How strong are they looking going into the next cycle?
Their capital position is incredibly robust. Their standardized CET1 capital ratio, that's the core measure of capital strength, is at 14.4%. That is well above their 11.4% requirement. So they have significant excess capacity to invest in growth or weather any kind of economic storm.
And they're pretty clear about returning that excess capital to shareholders.
Yeah.
How did that play out in 2025 with dividends and buybacks?
They executed perfectly on that philosophy. They boosted their quarterly dividend to $4.50. That's over 450% dividend growth since 2018. And on top of that, they bought back about $12 billion of their own stock in 2025. It just shows that management is committed not only to internal growth, but also to consistently returning excess profits back to shareholders.
Okay, so let's wrap up this deep dive on Goldman's 2025 performance. If you had to boil it down to three key strategic takeaways, what are they? First, you have the decisive end of the consumer experiment, the Apple Card era.
That's right. The cleanup is done. They minimized the drag from that exit, and now the deck is clear for them to have a laser focus on your institutional strength.
Second, that record-breaking success in global banking and markets. We're seeing total dominance in M&A, a huge backlog, and fundamental growth in stable financing revenues.
Which makes the whole segment more resilient. And finally, that aggressive pivot towards stable, fee-based revenue in asset and wealth management. They hit record assets and are chasing that massive $750 billion alternatives target by 2030, which structurally improves their entire valuation profile.
Right. The CEO's final message really reinforces that. He said they expect momentum to accelerate in 2026, activating a flywheel of activity. It positions the firm to exceed its targets of mid-teens returns and that efficiency ratio around 60%.
It's a very compelling story of a strategy that has been successfully completed.
Which leaves us with a final provocative thought for you to track going forward. If the entire strategic pivot really hinges on using that 1GS 3.0 AI model to drive efficiency in these traditionally costly areas like compliance and reporting, then how quickly are we actually going to see that efficiency ratio target drop below 60% as those AI-driven automations really start to hit the bottom line? That drop is the real metric that will prove the AI investment paid off.